Okay, so good day to each and every one. Today, I want to introduce you to the concept of provision for unrealized profit. But in order for you to appreciate this concept and recognize it well in daily life or during our practical applications, we have to understand what we term as provision. So when you are making provision for something, you are thinking about the future. You are timing a certain amount for a probable future. You don't know what will happen. Unrealized profit comes as a result of you producing goods. And these goods that you were expecting to sell, you are not able to sell all. Because if you decide to produce and sell, definitely you will add some margin or profit on the cost of the goods that you've manufactured. And the intention is that you are going to make a full sale of the items that you've produced. So look at this scenario that I have placed here. This is just a trial balance extract, meaning it is not a full trial balance. That's why you don't have the totals here. What will make you recognize provision is that when I take a question or I take a financial report and I see that there is an open inventory of finished goods, that means last year the goods we produced and intended to sell, we couldn't sell all. That's why we still have some of the inventory. So this one, we are not going to use it. We are not going to use the work in progress, but we are going to use the finished goods. It's very, very important. We are lucky that this question has given us provision for unrealized profit at the beginning of the year. So since we have provision for unrealized profit at the beginning of the year, we are lucky that the opening balance or figure has been given to us. So in doing this, you basically have to give the heading provision for unrealized profit. Even if the question hasn't given you the opening balance for the provision for unrealized profit, but you have finished goods at the beginning of the year, you can even reassess yourself, recalculate and see whether it's correct or not. So opening balance or balance as per trial balance or balance as per TB. This is how you work. The profit of the company or the manufacturing profit is 20%. That means that if they finish producing the goods, they add a manufacturing profit of about 20%. That is a markup. But because the finished goods have been valued at margin, you can't apply the 20% straight on the finished goods unless you know the cost of these finished goods, of which we don't know. So this is margin. And when you say margin, a profit percentage expressed on the selling price. We decided to sell these finished goods. We couldn't sell. And therefore, the value is no more cost. It's what? Selling price. So we can't apply straight the 20% on 3,000. It will be wrong. This 20% is markup because it was supposed to be applied on the cost. So we have to change from markup to margin, of which we have to add the numerator to the denominator. So it will be 20 over 100 plus 20, which will be 20 over 120, multiplied by the selling price of the finished goods, which will be 3,000. If you don't get the 500, we are wrong. So you take your calculator, 20 over 120 multiplied by 3,000 give us what? Yes, 500. So it means the provision for unrealized profit at the beginning of the year is correct. It's 500. Our duty is to determine the closing one. So when we get the closing one, since it's a provision, we compare the opening and the closing. If it is increase in provision, it becomes an expense. If it's decrease in provision, it becomes an income. So let's do the closing or final or closing. The final or closing provision too will be based on the closing finished goods. This one was based on the opening finished goods. So the closing finished goods is how much? 2,000. So the 2,000, for us to find that provision, it will be 20 over 120. Someone will ask, why is 20 over 120? Because the profit percentage is 20%. And the closing finished goods is always valued as selling price, not cost. If it was cost, we can apply the 20 over 100 straight. But since it's at selling price, we have to apply 20 over 120 by the 2,000. And it will be how much? 333 point. So let's make it 333. Good. The initial figure for the provision was 500. At the end of the year, it has reduced to how much? 333. So what will be the difference? So we have reduction or decrease in provision for doubtful debt. Decrease in provision for unrealized profits. It will be 167. So since we've gotten a decrease of 167, decrease in provision becomes other income. And since it's other income, when it goes to your statement, income statement, other income, you have decrease in provision for unrealized profits, 167. When you get here, you are not done. The next step is that the final provision you've gotten was 333. And this is the profit that is on this finished goods. So we have to eliminate that profit from the finished goods to get the actual cost. And the reason why we are doing this is because of what? The prudence concept. As an accountant, you shouldn't anticipate future profits, but rather anticipate future losses. So this closing finished goods that you will send the value to your statement of financial position. When you finish, you come and adjust the finished goods. Finished goods. So we have the balance already given. The balance was 2,000 according to the additional information. Then we less final provision. The final provision for unrealized profits is how much? 333. Please, always don't forget. If you don't take it, you will come and deduct the 167. So 333 from the 2,000 will be what? 1667, right? So this will be the final cost for the finished goods. The reason why we are also doing this is that we don't want a situation where by next year we are not able to sell these same goods. And we have to go and explain ourselves to shareholders that we were expecting to sell it at 2,000, but because we couldn't get the money. So you, the accountant, recognize that provision, deduct it. So if next year you're able to sell it at 2,000, it's a plus. If you're not able to sell it at 2,000 and even you get a 1667, it's also good. So that is the main concept about the provision for unrealized profit. This one, sometimes to be given to you. So instead of you computing for this, you just state the 500. It's similar to the treatment of provision for doubtful debt. With provision for doubtful debt, they will give you the initial figure and you come and do for the final or closing. Provision for doubtful debt arises as a result of what? Receivables, those who are owing us. And provision for unrealized profit too will come about as a result of the goods you couldn't sell, finished goods. Provision for doubtful debt, they will give you a percentage. You apply on the what? On the receivables figure. Sometimes additional bad debt will come. You have to deduct that one first before you apply the rate. The same way applies to provision for unrealized profit. That one, it is computed on the finished goods. It came as a result of the finished goods. That's why you see that always the percentage is applied on the finished goods. This one, this calculation that we did, we just wanted to confirm whether the 500 they've given us is correct or not. So always, if you get a question and you don't see provision for unrealized profits, the initial balance or the opening balance in the trial balance, but you have opening finished goods, you can work out for your provision for unrealized profits. This question, we are lucky that we have it here. If you don't have opening finished goods, we are not going to get opening provision for unrealized profits. It goes hand in hand. So I think that's all. If you have any question, you can chat me. Thank you very much. Have a wonderful day.